please make your introductions for the record.
Stephanie Zimberg, representing Commissioner Phil.
Allison Hirsch, representing Controller Brad Lander.
John Dorso, alternate designee for Control Brad Lander.
Steve Meyerman, invited participant.
Kevin Mayer, representing Mayor Agnew.
Phil Dukes, representing Finance Commissioner Preston Nyblack.
Joe Alejandro, PBA.
Arthur Wagner, PBA.
Rob Appling, Wilshire, by invitation of the trustees.
Nicole Jambrisi, New York City Police Pension Fund, present by invitation.
Jeffrey Ward, DEA, and proxy for the SBA.
Lou Turco, LBA.
Johnny Ramirez, CEA.
Andy Vincent Miller, Police Pension Fund, present by invitation.
Bob Sanskisted, Pension Fund, present by invitation.
Kevin Holloran, Pension Fund, present by invitation.
And Ed Berman, here by invitation this morning.
Maria Lambros, Police Pension Fund, present by invitation.
And we also have one more, Armando.
Okay. Law Department?
I think they signed off.
Okay. John, I'll hand it over to you.
Recognizing that.
Sorry, guys, just want to jump in. Chris McGrath, PBA by invitation.
Sorry about that, Chris.
So,
That's okay, guys.
recognizing we have a new stenographer today, I'll remind everybody to just use your name when you're addressing anyone. So this is John Dorser from the Controller's Office. Just noting that there are several members of the Bureau of Asset Management investment team that are on, as well as some members of our legal team. In the event that they address the board, we will ask that they identify themselves for the record. And I'll also note that there are members of the actuaries team and several consultants that are also joining via Zoom that will also ask to identify themselves if they have cause to speak at today's meeting. So with that, we have a very small agenda for public session, small in items, but not in volume or in information. So with that, we're going to turn it over to Steve Meyer, the Chief Investment Officer, to walk us through the quarterly report. So,
Great, John. Thank you, and good morning, everyone. It's good to be here again. It's going to give you a quick update on 2022. Obviously, it was a very challenging year for both the U.S. economy and financial markets. We had slow economic growth. Remember, the first and second quarters of last year were both negative growth. We had June inflation peak, CPI at 9.1%. We saw substantial declines in both stock and bond prices in tandem, which is a little bit unusual. We also saw elevated geopolitical risks associated with Russia's invasion of Ukraine. We had a changing dynamic between the U.S. and China, which is ongoing. And we had the most aggressive Fed rate hikes in 40 years. And unfortunately, I do think 2023 is likely to be another challenging year for both the U.S. and global economies, as well as financial markets. And we've seen evidence of that year to date. So let's take a look at market conditions and the outlook for financial markets on the next slide, Kate. Inflation obviously is high here and abroad. You can see the headlines talking about Eurozone inflation being marginally higher in January.
Hold on, Kate, one second. Kate,
If you could advance.
we're a slide behind, I think.
Yeah, there we go.
Thank you.
Thank you, Kate. I actually told Kate we're going to move quickly today, so she's a little behind. That's all right. UK inflation, obviously. UK inflation also high, still double digits. It's come off the boil, but it's still over 10% in January. Fed Chair Powell's reflected that the disinflationary process in the U.S. has begun, and we are off, I think, in that 9.1% peak in inflation we experienced last June. Next slide. U.S. inflation is well up, as I said, that June 2022 peak of 9.1%, but it's still over 6%. This slide, if you look on the far right-hand side, the upper white part, that's the CPI, at again, 6.1%. And the Fed's preferred measure, the core PCE deflator, at just 4.7%. And we get the next print of CPI next week. Next slide. U.S. inflation levels tend to be stickier these days at around 5%. I think that'll probably settle out to be sticky between 3 and 4% later this year, which basically means the Fed's got more work to do in terms of raising rates, and they're likely to be higher for longer than the market currently expects, and bond prices are pricing in. The next slide, around the world, we see inflation elevated, but it is coming off the boil. You see that on the far right-hand side of the chart, with the UK still being high, followed by the Eurozone, and again, US a little farther along in that process of reining in inflation. On the next slide, some key inflation drivers. On the left-hand side of the screen, you can see that's the US headline inflation. Our inflation here in the States is dominated less by food and energy and more by services. And that is the opposite of the condition in the Eurozone on the right. You can see that dark blue line is food and energy. That's obviously a result of the Russian invasion of Ukraine, which has put upward pressure on energy prices and food prices there. On the next slide, the key inflation driver in the States is not goods and services. You can see on the far right-hand side of that slide, the green line, which is downward sloping. That's food and energy. Services, however, that blue line continues to move higher, and a lot of that has to do with just demand and also wage price inflation, which we'll talk about in a moment. On the next slide, consumers generally in the U.S. expect inflation to come down in the next year. You can see we're well off that peak in terms of expectations, but still relatively high at a 3.9% expectation. Moving on to employment on the next slide, we had a monster January payroll report that came in with a 53-year low in the unemployment rate of 3.4%, over 517,000 new jobs created, and you can see the headline on the lower left-hand side. It was stunningly good, and the real question is, was that due to seasonal factors, and is that going to continue? We did another non-farm payroll report for February this Friday, and that's a very important print. On the next slide, look at the components of our unemployment here. We had a decline in the unemployment rate, that white line on the far right-hand side, it's just 3.4%, again, a 53-year low, but the participation rate is even moving higher at the same time. That's a good sign. On the next slide, you can look at where the demand is coming from a hiring perspective in the States. Those far, on the far right-hand side, those are all services, healthcare and social services, professional services, and leisure and hospitality, again, in the service industry. So service economy in the U.S. is very hot. Next slide. It actually shows the differential between the number of job openings and the candidates seeking those jobs. And we still have an imbalance of about 5 million more jobs than we do have candidates in the States. So again, part of that has to do with COVID, demographic shifts, immigration policy longer term, and birth rates, which are very, very low in the United States as well. On the next slide, taking a look at economic growth. U.S. economic growth in the fourth quarter actually was revised down to just 2.7%. Again, that's a below trend outcome. We see that with China reopening and putting their COVID protocols aside, that there's an expectation that that will drive and support European and U.S. growth as well. The expectation there is for growth to increase from 3% in 2022 to 5% plus this year. The upper right-hand side, the sharp, long-lasting slowdown to hit developed countries hard. That's a quote from the World Bank, which is a little dire, I think perhaps a little overstated, but again, time will tell. On the next slide, you can see that we do see that growth starting to normalize after very tumultuous years associated with the pandemic, but again, clustered in the lower right-hand side at just below 5% in aggregate. The next slide, consumer sentiment. This actually looks at prospective home buyers. We had a significant rally in bond yields, meaning prices moved up in January, and it actually breathed some new light into those individuals that are looking for housing. I think that's reversed, though. We saw a 100 basis point rally, meaning decline in 30-year mortgage rates. 3/4 of that has been retrenched in February. Rates have moved higher again, so that's probably going to continue to slow. On the next slide, this is the most anticipated recession of all time if we do have a recession in the States, and these are professional forecasters assessing about a 44 or 45% chance of a recession in 2023. The next slide, we see the expectations, just a general in terms of expectations for a recession in the U.S., European Union, and the UK. Those are all clustered on the upper right-hand side of that chart. And on the bottom, there's China coming off of its COVID policy, a little bit of a boom there, and again, it's more of a managed economy, so a lower risk of recession. But if you look at this, there's a high expectation of a recession at some point in those three major centers, the UK, the US, and the Eurozone. On the next slide, more rate hikes are clearly coming, but we've definitely closer to the end of the hiking cycle, and that's both here and abroad, although there is more hikes to come in all areas. On the next slide, let's take a look at our official rates and financial conditions. Far right-hand side of the upper chart, that's the rapid increase in rates that we've experienced since the Fed initiated its hiking cycle in March of last year. There's more to come. There's probably another 2 full hikes priced in. One's expected for later in March, and again to follow. We're waiting to see the summary of economic projections of the dot plots, which will be released in 2 weeks from the Fed at their next meeting, and see what they expect the terminal rate to be. Right now, it's 5.1%. It's likely to go higher. Next slide, just a look at the rapid pace. You can see in red there of how quickly the Fed has raised rates, about 450 basis points. It is the highest rate hiking cycle in 40 years. Again, these hikes tend to work with a long and variable delay, so the true impact on the economy is yet to occur. And again, there's probably another 2 or 3 hikes coming. Financial conditions on the next slide. Financial conditions here in the States, which is the white line, is actually looser. Above the 1% limit or the zero limit here, it means they're easier. But in Europe, that green line on the lower right-hand side reflects fairly tight financial conditions in Europe, which is a headwind for growth. On the next slide, taking a look at rising bond yields into 2023. Bonds have actually rallied significantly in January, as I mentioned, only to give it all back plus some in February. So rates actually started, 10-year Treasury rate started the year at 3.88, went down to the 3.30s, and is now back close to 4%. Far right-hand side talks about the yield curve inversion. I saw when I was on the ARC trainer at 5:30 this morning, it was at 90 basis points, but it's at a fairly high level, and that reflects that the market is expecting a recession at some point, followed by an easing in official rates. Next slide, just another look at yield curves. You can see the most recent one being the end of the year in red, still inverted, meaning that short-term rates are higher than the long-term rates, which is unusual. And on the far right-hand side, that chart reflects the level of inversion, which is the highest it's been since the early 1980s, at a 90 basis point differential between 2-year yields and 10-year U.S. Treasury yields. Just a quick look on the next slide of 2s and 10s, really focusing more recently and year to date. On the right-hand side, the white yields are for U.S. Treasuries, and right now they're about 4.90, slightly below that, I think, right now. And as I said earlier, 10-year Treasury yields are about 4%. So normally you receive a maturity premium by going out and taking more long-term risk, and that is not the case. At this point, you're able to achieve another 90 basis points in return over 10s buying 2s. Credit spreads on the next slide. They're fairly valued for an economy that is not going into recession. The orange chart or bar actually shows you that those are high yield spreads over comparable U.S. Treasuries at just under 4% at 397 this morning versus investment grade spreads at 120. Fairly valued, but I don't think compelling at this point. I tend to like them over 500, and if we're expecting a recession, closer to 600 for high yield. On the next slide, the U.S. dollar is off its 2022 highs, but still it's strong, and expectations for higher interest rates, as well as eventual and economic recovery in the States, which is, again, supporting the dollar. The next slide just looks at those 3 main currencies we typically talk about. On the upper part in white, the line is, that's the euro, how many U.S. dollars it buys. Right now, the euro buys $1.06. Late last year, it only bought 93 cents. In the middle, the pound still buys $1.20. Late last year, it only bought $1.03, so the dollar's weakened. And then the bottom, U.S. dollar in terms of Japanese yen, it was purchasing about 150 yen. Mid last year, it only buys 136 yen now. So the dollar's come off the boil, but is still relatively strong. On the next slide, getting into stock and bond market returns, 2022 was rough. The S&P was down more than 18%, Russell 3000 comparably down more than 18%. Bonds had their worst year in many, many decades. I read a quote that actually said it was the worst bond market since the 1800s, meaning the 1790s, which I don't know where they get that data, but it was a very challenging time for bonds. Evidence of that is on the next slide. The far right-hand column actually shows those global government sovereign debts. And the top one is the U.S. Treasury. These are 10-year yields. And over the last 12 months, they're up 211 basis points, and they're consistently up across all manner of developed market sovereigns across the board and substantially. On the next slide, taking a look at volatility. On the left-hand side, that's the VIX index, which is evidence of expected or implied volatility in equities. Right now, it's about 18, almost 19, which is at a 30-year historical average. That green band in the middle is kind of no man's land. Below that is actually risk on, meaning the risk assets tend to rally. And above a 30 level in VIX, typically it's a risk off environment where there's more selling. On the right-hand side, that is the MOVE index, which is a measure of bond market volatility. And you can see that it's well above its 30-year average. Still, it's elevated this year. So a lot of volatility in fixed income, more than equities. The next slide basically shows that as well. And you can see the differential on the right-hand side. That green line is a measure of bond market volatility, and the blue is a measure of equity volatility. So again, bonds continue to be relatively highly volatile. Market returns on the next slide, you can see that on the left-hand side, or right-hand side, you can see that there's been improvement in pricing for the European or developed market ex-US stocks, as well as emerging market, and more importantly and more dramatically in the US markets as well. But they still are below where they were significantly last year. On the right-hand side, that's a look at the Barclays US Ag. You can see it's come back from its lows reached in October of last year, but still well below where it needs to be and still generating a negative return. And on the next slide, this is basically a look at a 60-40 split. Even though we are still 15% below where we were in December of 2021, the 60-40 split is still delivering an average annual return of about 8% since 2012 over the last 10 years. So still a way to think about things, good way to think about things. On the next slide, just to look at why the recession is always 6 months away. We basically have a global economy that is still showing some vigor, particularly in the States. The job market is surprisingly hot in the United States in particular, with a 53-year low unemployment level. And that continues to be reflected in U.S. jobless claims, which are below where they were pre-pandemic. A couple things to think about on the next slide. A look at inflation relative to where it was in the 80s. And we all remember that. In the middle of the chart, there's actually, it looks at 2 years where it took the Fed 2 years to bring inflation back down to where it needed to be through tightening its policy. The 74, 76 era was when Hamburger Helper and Tuna Helper actually reared their ugly heads in the Meyer household. And I remember that time very well, as well as the 80-82 period when I actually worked as someone that would stand in line to get gas for my dad's company.
You were eating well back then, Hamburger Helper. Come on, that was pretty good. Yeah,
my mother would supplement it with cashews.
That's pretty good, man.
And I said the last slide, just in terms of food for thought on the next slide, this is why everyone keeps focusing on when's the Fed going to pause. Because typically, 12 months after the Fed pauses, we on average see a 15% increase in the S&P 500 performance. So that's why everyone keeps looking at the Fed, hoping that they're going to stop raising rates. But as I said, I think
not today. Powell just said he's not going to do it.
No,
not right away.
No. Did he say how many more?
Last he said, let me see, just
at least two.
Yeah.
Daddy would have pinned himself down because he's got employment.
He's just saying he's not going to go down right, anytime soon.
Kate, if we could please advance this to slide 38, just to look at performance now. This actually looks at public market returns for the fourth quarter. The 1 year is just ugly in terms of all that red, and it's consistently bad across fixed income and equities. More importantly, though, the third quarter, we actually had a bit of uplift. There was a little bit of recovery in terms of equity and bond prices, with the exception of very long duration in the middle. That 10-plus year maturity has got a very long duration and was down a little bit. When you look at public market and returns, you tend to want to be, as a pension plan manager or trustee, look further out. So 5 years, still the returns are relatively reasonable. But that only includes public markets and not private. On the next,
So you know, Powell said, Federal Reserve is likely to raise rates higher than expected.
yeah.
Not recent strong data, so we're gonna have this for a little while longer.
Yeah, and we'll see how inflation works out. The next slide is actually a look at our net public market returns by strategy. Again, focusing on the positive on the far right-hand side. Actually, Kate, I think you're one slide ahead of me now. There we go. On the far right-hand side, again, you want to look at net public market returns by strategy, which are actually pretty consistently strong, with the exception of emerging markets, which have kind of stumbled along on the equity side, really since the global financial crisis. More importantly, again, because it's a quarterly update, the 3-month figures are all positive, with cash being almost the only asset class that's generated a positive return. We have a zero allocation to cash, but we always hold some level of cash to meet capital calls and to make benefit payments. On the next slide, I'll look at our private manager returns.
Before you out, just explain to me very quickly, because you always forget these things. Why is cash showing a 1.6 return on the 1 year? Is that inflation?
Yes,
Okay.
yeah, it's also written, the rates moving higher as well. On the next slide, were they already there? Well, there's a lot here. This is the private market returns by strategy and for the plan. Hedge funds, you can see, looking at 1 year on the upper chart, obviously had a solid performance in 2022 for the year because of their, even though it was a pretty flattish return, that's relative to, again, 18% down in both equity and bonds generally. Private equity continued to generate positive returns, as did core and non-core real estate. Infrastructure, which is a very strong hedge against inflation, and a lot of times those contracts that underlie those strategies are indexed to CPI, had a relatively strong performance. And opportunistic fixed income tends to be more floaters, but it's below investment grade, and there's been a little bit of widening in credit spreads through the year. Below that, and most importantly, the police total plan for 3 months outperformed its benchmark, its policy return benchmark, by 40 basis points. But more importantly, for the 1 year period, it outperformed its policy returns by 310 basis points. And that's, again, in the middle of the lower part of the screen. That 13.7 is the policy return on a negative versus a negative 10.6. So strong performance on a relative basis in a bad year. On the next slide, I'll look at the total return and the composition of that. So basically the excess return, that extra 40 basis points, was due to strong performance in investment manager selection, delivering 90 basis points of excess return. Relative to underperformance, we were basically overweight the public markets, not the private markets, the public markets, in a year where risk was off and those assets didn't perform well. But again, still 40 basis points above that target return. On the next slide, I'll look at your public market excess returns by strategy, focusing again on the 3 months of the quarterly returns. Relatively strong for equities, less so for developed ex-US equities, just down 12 basis points below expectations. We also had a significant outperformance in convertibles. Our portfolio tends to be more conservatively positioned right now, which is why it underperformed the benchmark in 3 to 5 years, but has outperformed in a risk-off market that we've seen the last year. And the total outperformance I talked about earlier, in the 3 months, 1 quarter, is 41 basis points versus excess return relative, again, to the benchmarks of 304 basis points for the year. Next slide. I'll look at the private market excess returns, which are pretty strong across the board with the exception of non-core real estate. Non-core real estate tends to be more risky. There tends to be value add and opportunistic, where there's more work getting done. In a risk-off environment, those have underperformed the benchmark by 800 basis points. Typically, the value add opportunistic has a spread of 200 to it, but in this case, it doesn't. So again, significant underperformance there. I think the real success story, though, is the private equity relative to the Russell 3000 benchmark, outperforming by 2,100 basis points, or 21%. Again, an excellent performance there. But again, those assets tend to be priced with a lag. On the next slide, just to look at capital flows. We basically had sold public market equities to raise money to meet distributions to beneficiaries, as well as to meet capital calls to the tune of $505 million. And last and not least, the final slide basically represents that we are within tolerance of our target ranges across the asset classes consistently. And again, I mentioned cash is going to always be overweight or always in the green, because there's a zero allocation of cash for strategic reasons. And with that, I'll open up to any questions.
So if there are no questions, we have a risk presentation that will go along with this as a companion presentation. And I'll remind all the trustees that Steve and Ed, of course, are always available to answer any questions between meetings that folks have regarding the portfolio. So with that, we'll turn it over to Ed Berman, our Chief Risk Officer.
Okay, talking from the corner.
Before I get started, at one point, Ed and I are just going to show up and we're going to swap slide decks, and I'll be the risk guy, and Ed will do the market commentary. Keep it fresh. Sorry, Ed, go ahead.
That's a good idea. Today, my goal for today, so over the next 20 minutes or so and 7 pages, to give you a sense of comfort about the current positioning of your portfolio and what may happen in the future. So obviously, a lot of things happening in the portfolio. It's about $50 billion of assets. It's a mature portfolio. You invest in dozens of managers, all asset classes under the moon, all regions in the world. A lot of things may go wrong. So today I want to answer 2 questions. So first of all, if there's something you need to worry about today, and there's something you need to worry about in the future, and to give you some intuition how the portfolio may perform. But first of all, we need to define what risk means. And the risk is a good measure of answering these questions. And of course, we take a lot of risks, a lot of moving parts. We're not trying to avoid risk. Risk is good, because that will give us returns. But the key to that is your risk exposures need to be aligned with your investment process. Everything needs to be as intended. So from a high vantage point, there are 3 main levers that will influence your risk and, by extension, the returns. That is the markets, the portfolio construction process, and anything that the managers do, all the technicals, rebalancing, cash flows, everything that we are doing day to day. So we define risk in terms of performance. And there's actually no unique way of defining risk, but for a large multi-asset portfolio, the most natural way of defining risk is just to say it's the expected performance over 12 months. And because nobody knows the future, we say it's a 70% probability that we'll hit this performance, meaning there's about a 15% chance of outperformance and 15% chance of underperformance. And much like we talk about 2 measures of risk, we talk about total returns and excess returns, and both are important for different reasons. We have 2 different measures of risk. We talk about total risk, which is a measure of total returns, and we talk about active risk, which is a measure of excess returns. So you can see these numbers in this table on screen in the bottom right corner. And the total risk at the end of fourth quarter was 13%, and active risk was 2.2%. So are these good numbers? Should you panic about them? Do you have a sense of comfort over these numbers? So let's just take a step back a little bit. As I said before, it's the markets, the portfolio construction, and the managers. Let's just peel the onion. I'll move a little bit faster than last time because the conversation is broadly very similar. Not much changes to the 50 billion portfolio. But let's start with the markets. If you focus on column 1 in the table, and markets is really just the broadest measure of diversified portfolio. We take a 65-35 blend, 65% MSCI World, which is the broadest measure of equities, and 35% of market cap, which is a broad measure of fixed income. And within this 50 billion portfolio, you actually take just 3 types of risk. You take equity risk, you take interest rate risk, and you take credit risk. Again, I'm not going to talk in details about it. I'm more than happy to answer any questions, but if you focus at the top of this table, on the left corner, you see the definition of these dimensions of risk. So we take 65% allocation of equity, we take 2.2 year of duration of interest rate duration, and 1.3 year of credit spread duration. This is our baseline. This is the starting point for our journey. What does it mean for risk? You can see the bottom of the table. And these are produced by our risk system, bar 1. And you see that the total risk for the market portfolio is 12.6%, slightly up from the previous quarter. This is market. That's what's given to us. This is outside of our control, and this is our baseline. And the second measure of risk I haven't mentioned so far, you see at the very bottom of the page, is data to the S&P 500. Remember, we defined risk as a 12-month performance, so the data gives you more of a short-term view over your portfolio. So the data of 0.61 means that for a 1% move in the S&P, your portfolio will change the performance by 61 basis points. That's all there is to it. So now that we have this baseline, let's move to the next level of decision-making process, the portfolio construction. So that's where we split the equity portion into domestic equities, European equities. We split fixed income into investment grade and high yield. And altogether, we make 13 allocations. You can see at the bottom of the page, they're reflected in your strategic benchmark. And with all these changes, so what does it mean? So you can see under portfolio construction that your policy benchmark is closely aligned with markets. The equity allocation is slightly higher, 2% more. The duration is slightly less. That's just the way the portfolio is constructed. What does it mean for risks? Column 2 at the bottom of the table, the risks actually came down. Instead of 12.6 for the market portfolio, the risk for the strategic benchmark at 12.2. That's a good outcome. It's slightly counterintuitive. We put more into equities, which tends to bring risk up, but we increased diversification, meaning we have more money. The equity more performance, risk came down, so good. So the benchmark works for this quarter. And finally, we can move on to your portfolio, which is captured in the column C. Again, this is from very high vantage point. We'll dive more into the following, more inside the portfolio in the following slides. But you can see, first of all, that the equity allocation is aligned with the benchmark, 67.8% versus 67%. The durations are closely aligned with small differences, mostly because of the ETI program. And what's the punchline? So now we'll go back to the risk how we started the discussion. You can see that the risk at the system level is 13%. So you're running about 80 basis points higher than the benchmark. And the beta is also running slightly higher. So the portfolio is at slightly higher risk level. And here we have the second measure of risk, finally, the active risk, which just to remind is a measure of excess returns, and it's running at 2.2%. Meaning that you may expect your portfolio to deliver excess returns versus the benchmark, which I assume exactly as was intended. And finally, I want to draw attention to these 2 charts on the right-hand side of this page. First of all, the top chart, chart 1, shows you the evolution of the total risk for all these 3 portfolios over the last 12 months. And you can see that this relationship we just discussed, it held the same over 12 months. So no big surprises. And at the bottom of the page, you see the active risk, which is a measure of excess returns. Again, it's broadly the same. You see a small pickup, like roughly around September of last year, and that's really a result of the market volatility. We're going through two unprecedented times. Steve just talked about it. It came down slightly, and that's, again, nothing we did. It just the market volatility comes down. So what are the main takeaways from this page? I actually think this is your most important page. This is your single validation for your portfolio. First of all, the risks for your portfolio are closely aligned with the benchmark. And why is that so? This is because we see that the risk level is actually very close to the benchmark, slightly higher. We know that the expected performance of your portfolio is driven mostly by the market, not by something managers do. That's important for two reasons. First of all, why we see that? We see that because the risks of the market portfolio are very closely aligned with the risks of your portfolio. Synthetic returns are mostly about market. It also tells you that the managers, and we use thousands of managers across all asset classes, altogether, they're not doing anything unusual. Again, because the risk is very closely aligned. And finally, we can say that for this quarter, there were no unexpected changes in your portfolio. Why is that? This is really just by following these charts on the right-hand side, there are no big changes in the portfolios. So with this in mind, we'll dive a little bit more inside the portfolio, take a closer look, and okay, can we have the next page? Thank you. So here we look at the components of risk. So first of all, let's focus on the left-hand side of this page. So that's where we look at the total risk and the components of the total risk. And remember that your portfolio is multi-asset. It's a 65-35, meaning that 35% allocation to fixed income. That said, if you look at this chart, this really narrow orange band at the very top, and that's fixed income. And even though we allocate 35% to fixed income, it's only 8% of total risk. Why is it important? That's in a way frames your expectations for the performance. So you may expect over the next 12 months, so fixed income will contribute only about 8% to the total performance. You also notice that this orange band is actually on the positive side of risk. And one of the roles of fixed income in your portfolio is to provide risk diversification, to cushion the sell-offs in the equity markets. This didn't work so well in the past 12 months, and that's, again, going back to what Steve was talking about in terms of positive stock-bond correlation. That's what it means. It means that fixed income is not helping right now. Is it even the panic? Not here. It's something we expect that perhaps as inflation comes down. It may take a little longer, but it doesn't really repudiate the basic concept from all the asset portfolio. So what dominates risks? It's the green band. That's public equity. So public equity is 40% of allocation, but it's actually 61% of total risk, meaning public equity is very important. But also notice this blue band at the bottom. This is private equity. So private equity is only about 10% allocation in your portfolio, but it's almost 20% of total risk. Right? And we all know that private equity has been very helpful in terms of performance, in terms of absolute returns, in terms of smoother ride, but risk is risk. And at some point may revert, and something to keep in mind. Lastly, I want to focus on the right-hand side. Right, so going to the active risk, remember there are two sides to risk, this total and active. So now we're talking about active returns. We just mentioned that active risk in your portfolio is about 2.2%. So what is it? So again, we're looking at the 12 months of history, and it's all blue. Blue means private equity. So private equity dominates your active exposure and active returns. It's not really surprising, given that we benchmark private equity against the Russell 3000. Russell 3000 behaves very different from private equity. So it's not surprising. So what's more interesting is that public equity is actually barely visible here. So the green band is quite narrow. It basically indicates that as the portfolio stands right now, we do not expect a significant excess return from our public equity managers. And the last point of observation here, fixed income. So fixed income, which is the orange band, is actually on the negative side. So in the current market environment, fixed income will detract from the asset returns. Again, going back to the stock-bond correlation, it's something to keep in mind, but it's something we expect to change going forward as inflation comes down. Again, no big surprises, and I think in the context of this presentation, no surprise is a good message. We don't want surprises here. So let's take another dive deeper into the portfolio. Okay, can we have the next page? And here, it's a little busy slide, a lot of numbers, but unfortunately, we need these numbers to understand the performance. So here we look at the individual asset classes, individual buckets, or is aligned with our strategic benchmark. So first of all, column 1, which is allocation for the system. And usually the most important column here is the overweight, underweight. This is here just to assert that we do not have significant deviations from the benchmark, anyway, the portfolio. There's a slight overweight towards private equity, which I hope everybody is familiar with, right? Plus 2% private equity, slight underweight for private infrastructure. And of course, the famous denominator effect will take slight underweight on the public side, which is spread between equity and fixed income. Hopefully no surprises, everything as expected. The next step in our journey is the risk level of risk. So that's column 2. And that's where we show the risk level for each individual asset class and how much they contribute towards the portfolio. And actually see the same information applied on the chart at the bottom of the page with the easier to follow. And here I focus more on the orange bars. That's the risk contribution. 2 bars stand out here, and that's US equities and private equity. And again, like I mentioned before, that equity is the most important allocation, but here we see that's actually the US equity that's more important than the rest. Again, it's partly by construction, partly a reflection of the market environment, but it's actually not a bad place to be. So over the long term, US equity delivered probably the best performance out of all markets globally. It's not necessarily a bad place to be. And the second measure of risk, we talked about total risk, again, active risk, column 3 of this table. We mentioned before that at the system level, active risk 2.2%, you can see at the top of the page. But what's important is to see how well risk distributed within asset classes. And again, it's very well contained. You can see the public equity, 0.8%. We're not taking significant risk. Active risk at the public equity level. Public fixed income, 0.9%. Again, risks are low. You see much larger numbers on the private equity side. So again, nothing to worry about. And finally, I keep saying that we define risk in terms of performance, right? So risk is the expected performance. So here we have a chance to see how well this expectation aligns. So much like our risk defined in terms of 12 months expected returns, we show the realized 12 months returns for the system on the right-hand side. Clearly, public markets didn't perform very well. You see all numbers are red, throughout equities or fixed income. Private markets helped us a lot. Again, the performance is strong. But here we're focusing more on the comparison between the risk and returns. And the message is it's mostly worked well. So on the public equity side, the total return compares very well against total risk. As we projected the risks, the returns delivered exactly the same. The excess returns were broadly in line. There's some deviations here and there, but nothing to worry about. On the fixed income side, the picture is actually quite different. If you look at the total on the absolute returns, they far exceeded our risk forecast. Is the reason to worry? Not really. Just again, going back to Steve's presentation, where fixed income right now, it's a unique once in a 2-century event. Do we expect our risk projections to go bust? Yes, that's exactly what it is. Because remember I said that we do expect a 15% outperformance and 15% underperformance. If the performance always within a risk forecast, something is wrong, right? So I should take it as an affirmation of risk model. Why is it important? Again, it gives you comfort of knowing that whatever risk we project is actually consistent with the performance. It's not a validation for the risk system, and more important, it's not a validation for the portfolio. So it's a positive outcome. Finally, so there are 2 questions I'd like to answer here. The portfolio as of today, close that part. Now we'll move to this portfolio for tomorrow, for the next 12 months. Can we have the next page, please? Thank you. So we answer this question through STRATA, which is hypothetical performance. And what are our goals? What are we trying to achieve? So first of all, we'll try to identify which markets are more important for the performance of your system, which markets we need to watch out for. We try to estimate the outcome for the system, and also use that as another insight into the performance of the portfolio. So our starting point is to identify which markets to focus on and to identify the stress shocks. And here again, your portfolio taps into everything and globally. But what drives, broadly speaking, the investment outcomes are 3 main factors. That is equities, rates, and real economy. And that's what reflected by the markets on screen. Within equities, the most important market will be the S&P, which is U.S. equities. The emerging markets, which includes China and other countries, and Euro Stoxx 50. So between these 3 indices, we're covering probably about 70% of global equities. It's a good representation. On the rate side, by far the most important interest rate is whatever's happening in the Federal Reserve. So we'll proxy it with the 2-year treasuries. The 10-year treasury is the best measure for the broad economy. That's what sets the rate for mortgages, for corporate borrowing. It's probably the most important real world interest rate out there. And finally, the euro-dollar exchange rate, which is a proxy for US dollar. And US dollar obviously has a very unique place in the global economy. It's a world reserve currency, and the moves in the US dollar impact the entire world, everything. It's probably one of the most important factors globally. And finally, the economy. Right, so the economy here is represented by commodities, and we pick 3 measures. First of all, copper. And copper is a proxy for the global GDP. Pretty much everything being produced, manufactured, uses copper everywhere. Oil is important for anything and everything. It's the energy, it's transportation, it's pretty much everything in the economy. And inflation is inflation. That's all we talk about, right? So we identify these 9 market factors, and the next step on our journey is to identify the shocks. So we use our risk system, we use FIRE1 for this purpose. And here we ask the question, what will be the worst monthly move, the worst excessive monthly move over the next 12 months? So you can see the result of this exercise on the table, and we show you the shocks for Q4, we discussed now, and also the previous quarter. 2 things stand out. First of all, these are truly huge moves. Just focus on equities. So we project that there is a material likelihood that over the next year, there will be almost a 30% shock in 1 month. These are big moves. We also showed that the European markets are actually the riskiest place to be. That's unusual. Historically, actually, the domestic market, US equities, are most volatile and most risky, which is mostly because of the technology exposure in the US market. In this case, you can see that S&P, MSCI, EM are at about the same risk level. Slightly up from the last quarter, but it's really the European equity markets that still show. On the rate side, again, these are big moves. The 2-year treasury moving by 1.4% in 1 month. That's north. An 11% move for the US dollar is a huge move. It has strong repercussions for the markets. You can see on the right-hand side of this page how these efforts performed for the last 2 years. You can see these numbers makes sense in the context of the recent price history. And the same is true for commodities. Again, we're talking about a 35% move for copper, 57% move for oil. But again, oil in the past 2 years went from being negative to being $120, right? So it's all relative. So what does it mean for your portfolios? Can we have the next page, please? Okay, thank you. So here we show 18 scenarios for the portfolio and 18 scenarios for the benchmark, so there's 36 projections altogether. And we show them split by the risk on, everything rallies, and the risk off, everything sells, right? So I'm focusing on the left-hand side, but the conclusion will probably be the same for both scenarios. So first of all, equities. You can see that the most important market is the domestic equities, US S&P 500. Again, remind you, all these moves are equally likely to happen, but a move in the S&P is projected to have a 17% return. You get less exposure to emerging markets, meaning less exposure to China. Again, it's a positive, and less exposure to European stocks. And you can see it's not surprising. We know that we allocate more to the US than to Europe, but keep in mind that just because of the S&P doesn't mean domestic. A lot of American companies derive material fraction of their revenues from abroad. On the rate side, the action is less pronounced, and it's probably the most interesting outcome of stress testing. Your portfolio is actually not that sensitive to the Federal Reserve. So you can see that the move in a 2-year results only in a 1% move for the portfolio. What's more important? It's the dollar. The move in the dollar will result in almost a 7% move for the portfolio. That's again, back to my point, the dollar has everything globally. It's one of the most important measures for the global economy. And finally, the commodities at the bottom of the page. Copper. Copper is important. And why is it critical? Your portfolio is positioned for growth, right? Through equities, through credit lending. A lot of it is the growth exposure, and as growth picks up, depends on copper picks up, your portfolio will benefit. On the inflation side, the sensitivity actually came down. Your portfolio benefits may be slightly counterintuitive from a pickup in inflation. As it expands nominal GDP, the portfolio benefits. So what are our main conclusions from this page? So first of all, it confirms that the performance under extreme conditions is projected to be consistent with expectations. Why is it so? We see that the excess returns for the portfolio is actually fairly small. So your portfolio performs with the benchmark. Your portfolio position is slightly higher risk level versus the benchmark. Again, we can see that delivers a positive excess return. It's mostly driven by private equity allocation. Another conclusion, your portfolio has actually little downside protection. And why I say that, you can see that the risk on and risk off scenarios deliver almost symmetrical outcome, which comes on the risk on, gives on the risk off. So there's not much downside protection. And finally, you can see that the portfolio outperforms the benchmark under every single scenario, but also underperforms the benchmark under every single scenario. With this in mind, I want to take a quick dive inside the portfolio. Okay, can we have the next slide? Mike, I want to talk about the today's exposures. Forward-looking, so here we show the asset class performance for the 3 most important scenarios for your portfolio: the S&P 500, the dollar, and the inflation. And several things stand out here. So first of all, looking at the equity performance, you can see that the bars are visually higher. So you can see you get more bang from the buck from the equity rally. You can say it's not surprising, but again, keep in mind, all these scenarios are equally likely. The rally in S&P is as likely as a seller from the dollar. but it's the dollar rally that gives you, I'm sorry, the equity rally that gives you the performance. You get more diversification for non-dollar rallies. And that's actually an important outcome, I'm sorry, for non-equity rallies. It's an important outcome. Because you get more, you can see that the green bars and the orange bars are more evenly distributed. Even though it's a multi-asset portfolio in the rising equity environment, it's all about stocks. And finally, there's little diversification in the portfolio. Right? And why I say that, so first of all, under any scenario, all bars point up, meaning all assets perform in the same direction. The only exception here is the inflation. There's a little bit of action from the fixed income. But again, under either scenario, neither core fixed income nor TIPS provided significant action. And finally, the last page, so we'll go one more page and also the end. Just to bring it all together, we talked about the projected performance and the future performance. These are the same charts you've just seen, so there's no new information here. But just to bring it all together, chart one, total risk, we said that it's all about equity. You can see it now in this table. Equity gives you more performance. Fixed income or commodities led rallies will not give you as much returns. And the active risk, chart number 2 at the bottom, again, we said it's all about private equity. You can see it in excess returns. You are not really generating significant excess returns other than private equity. Okay, so I'll stop there if there are any questions.
Any questions from the trustees?
Fascinating, but you have managed to perplex us again. But I appreciate all the work.
I'll be more than happy to go over those numbers. Obviously, more to be said. It's a complex portfolio. I understand that maybe a lot of numbers, a lot of charts, but I'll be more than happy to discuss.
Many of us stopped high school math, so, but I appreciate it. Thank you.
Okay, so you heard the quarterly report, the risk presentation. We have one additional item for public session, which relates to the IPS and the request for a waiver. So I'm going to ask John Gluzak, the head of real estate, to just give us, noting that we're in public session and the IPS is a public document, what the request is from BAM. And I don't know if Townsend is on, but I think it's safe to say John has spoken extensively with Townsend regarding the issue that he's about to raise. So, John, if I could do it swiftly because we have a full agenda.
Absolutely. So what BAM and what Townsend are recommending is that you take away or waive the IPS limitation on the industrial properties, which right now stands at 35%. Your portfolio as of the third quarter, based on NAV, is at 36.1% industrial. As you know, we've been tilting the portfolio more defensively over the past few years and trying to emphasize multifamily and industrial assets, to which you can actually see that we've achieved that in both asset classes. The portfolio overall is very well positioned. It's very well positioned defensively, and we're just asking you to take into consideration this waiver for now. Once again, realizing that your IPS was done in 2012 under very different market conditions.
So I see that Ish is on from Townsend. Ish, you have anything you'd like to add?
No, we did discuss this at length with BAM and are very supportive of adjusting or waiving this industrial guideline. As John highlighted, the IPS was done back in 2011, 2012. And at that time, the industrial exposure in the Odyssey, which is the benchmark for the real estate program, was about 12 or 15%. Today, the industrial exposure in the Odyssey is over 30%. So the market has really shifted. And it has shifted away from, retail and office into industrial and apartment. So just to for our portfolio to be better aligned to the current exposures in the market and to the benchmark, we believe that, this waiver that is being requested makes sense.
So Joe, recognizing that an IPS waiver is a broader discussion, I would suggest that we waive it for at least a period of 6 months, so that we can revisit the IPS and see within 6 months if it's appropriate. We could even go longer, but I recognize we don't want to waive it completely, or we don't want to remove the provision. So I would suggest we put a time limit on the waiver, so that we almost compel ourselves to look at it more holistically. So either a year or 6 months as the waiver period for this particular session.
Can I just make a sort of friendly amendment to that? I would say maybe waive it to the end of this calendar year, because that's the point at which we'll have a new asset allocation that this board voted up to commence last month, and B, will be John and Sam and Kevin will be putting forward the annual plan for next year, and therefore.
Just a new asset allocation review.
Review.
Right.
Correct, sorry.
And so.
We have not voted on new asset allocation, we have voted on a process to review the asset allocation.
And I appreciate all those comments, and I just want to make sure that, people understand where I stand on this. I want to be very clear. I don't take it lightly to change the IPS, but I am cognizant of the fact that the world does change, sometimes more rapidly than we expect. I do take notice of the fact that, again, some of the things have changed in real estate, given benchmarks and things of that nature, and I do accept that. I just, like I said, I always side with caution when looking to change the IPS. It has done us very well for the last few decades. Even though it was changed in 2012, we don't modify things willy-nilly. So I want to be very careful, and I do accept the fact that, maybe to the end of the calendar year, it's a good idea to do.
Okay, so I believe that, I'll make a motion that we accept the waiver until the end of the calendar year. Is there a second?
Second. For the PBA.
Okay, all in favor?
Aye.
Aye.
Any objections? Okay.
Okay, so John, you can go forth and update, so thank you. So with that said, I'd like to make a motion to exit public session and enter into executive session.
So we'll, second? Take a 2-minute break?
Yes, so we're now in executive session. We'll be taking a 2-minute break.
Okay.
There was a confidential.
Attorney-client.
Attorney-client. Do you want me to say that, or you have that in here?
You could say that. That's actually, yeah, no, you could put that in there. Okay, during the executive session, the trustees heard from their consultants, BAM, and several managers regarding the following: private equity, real estate, and hedge funds. Discussions were made. Those decisions will be made public at the appropriate time.
Additionally, off the record, the trustees heard counsel from the New York City Law Department on a pending litigation. Action was taken, details to be made public at the appropriate time.
So with that, I'd like to make a motion to adjourn.
Second.
Stand adjourned. Thank you all.
Tina will be here.